Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today we're joined by Portfolio Manager Hugo Lavallée as he shares his unique perspectives on navigating the current market. Hugo discusses the impact of recent interest rate cuts on consumers. While some relief is on the horizon, he notes that it's coming slowly due to concerns with reigniting inflation. Hugo explores the importance of time in his investment strategy. He emphasizes the value of patience in a market concerned with immediate results. Hugo reflects on how his investment style has evolved over the years, from quick trades to a more deliberate long-term focus. With inflation cutting into purchasing power and interest rates pushing borrowing costs higher, Hugo is particularly focused on consumer discretionary stocks. Despite recent struggles, Hugo believes in the underlying strength of these businesses and sees potential amid the current market discrepancies. This podcast was recorded on September 4th, 2024.
Well, let's get a little bit of an update on exactly sort of the big news in Canada. We've had a third cut. We know this. When we spoke to you, halfway through the year, you were sort of saying you were getting ready for a little bit higher rates for longer, which is exactly what happened. Bring us up to date a bit.
Yeah, we raised rates too late, right? And that created the issues that we know. So for me, it was all about credibility. It's got to hurt, unfortunately.
And it hurt.
And it is hurting. It is hurting. Definitely, it's hurting in Canada. It's hurting everywhere in the world. Some aspects of the consumer. Everybody's feeling it. We're feeling it in Canada. So, relief is on the way, but it's slow because we can't have the return of the crazy inflations we've had 2 years ago, and the bank's really focused on that.
Right. Okay, so there's a cyclical story in there. You start to see an easing environment. We've actually been in it now. Canada got going kind of early, maybe too late, but earlier than other banks. So what does that mean for what you go hunting for? Or maybe you've already gone hunting for it, but the consumer is sort of the obvious discussion here.
Right, well, so in the short term, what's going to do better probably is these interest rate sensitive, right? Because on a relative basis, all of a sudden they look better. So right now, there's a lot of uncertainty, a lot of businesses not doing very well. If you got a stable business and you're basically a bond, right, a dividend,
yep,
and maybe you're growing a little bit, and all of a sudden, the competition is, lowering what they're giving you, you're gonna look a little bit better. So I have some of that in the portfolio, but I guess I'm thinking ahead on, okay, where the pain is today, that the pain's been created mostly by this interest rate cycle, right? This inflation that's eaten into purchasing power. And now we have higher borrowing costs and people are feeling it. That's creating a lot of pain in some pockets of the economy. So that's what I'm focused on, because there's companies where the margins are down, the earnings are down, and now the P multiple's down also. So you're getting a lot of pain in some aspects of the market, and that pain took a long way to build, right, from the time that we've raised rates, and now we're on the other side. So that pro-cyclical early cycle, it's where I spend a lot of my time.
Okay, so early cycle, let's go through some of the sectors ultimately of what sort of on the other side of some pain, or maybe where things are troughing right now, so sooner. Where are you looking? So we're looking at consumer discretionary. Is that where you're spending some time?
Yeah, so definitely, consumer discretionary has been really tough.
It has.
Things that were COVID winners, boats and, snowmobiles or whatever, those have been incredibly difficult. Bikes, there were such good businesses good businesses in 21, and some of them are good businesses. And now we're totally on the other side of that. They've cut earnings multiple times. So that the lower income consumer is struggling in the United States, and that's one area to focus on, for me at least. Yeah, so the consumer discretionary, some cohorts of consumer, some cohorts of the economy like industrials. That's where the pain is. And, that's really where I focused since the beginning of the year. It's been a market of huge discrepancy between winners and losers. And I think the market is doing what it's done in the past. As the economy is slowing, the companies are still growing earnings and give you visibility. They're getting really healthy multiples, maybe too healthy, but the multiples are expanding because that earnings growth has become rarer and rarer. It's hard to find. So, if you're a most this consumer discretionary, most restaurants are struggling. So if your restaurant's growing your same store sales 10%, you're getting a really, really healthy multiple. So healthy that it might be hard to actually mathematically, re-engineer some real returns over time from it. Vice versa, if you're a company that is not doing well, it almost seems like there's no prices low enough, no multiples low enough. You can't really anchor to history. That's what I do. I anchor to past earnings, like I'm looking
where
at
they've peaked.
Yeah, where they've peaked in the past or pre-COVID, during COVID, looking at the current stock price to those conditions. And for some companies, maybe like bike manufacturers, might be really tough to get there anytime soon. Mm-hmm. But for some other companies, like, well, those conditions weren't too crazy, but now the margins are down, the revenue's down, and it's just a really tough set of circumstances. And can we go back to that at some point? And I'll give you, I won't name the security.
No, give us an example.
But there's a company I own, stock's $80 a share. They've had 3 years in a row of over $10 a share of earnings. Pre-COVID, they maybe made like seven or eight, and and they've keep growing the store count. So if you're $82 and you made $10, you're 8 times earnings. But they're not making $10 this year. They're going to make half of that. So those kind of the metrics that I use to try to get ahead over the next 2-3 years.
Super bad to kind of bad. It's
a
good place.
What I'm looking for is, exactly. It's second derivative, right? That's exactly how you said it. It's not about if it's bad, is if it's at some point it's going to get less bad, and that's very powerful for stock prices, and that's what I'm focused on.
Getting up off the floor, yes. No, it's fascinating, and this is sort of the contrarian way that you look at things. Discuss the market a little bit. This has not been, well, I don't think it's been a contrarian market. We've had 5 names that have done extraordinarily well through much of this year, and we've seen some broadening. Certainly, and there's other things that have done well. It wouldn't be your classic contrarian market, though. Am I wrong about that?
Well, year to date, it hasn't been.
Year to date, exactly.
So, I don't know what the future holds, but I'm preparing for obviously something different, right?
Right.
A rebroadening of the economy at some point, and it's I always say I'm a low expectation portfolio manager, right? I'm looking for low expectations, and it's been hard to low expectations because a lot of companies have been disappointing. They've continued to disappoint. So you haven't had that inflection yet.
Interesting.
And the strong companies, in tech or a few of the restaurant concepts like Cava or Sweet Greens, they're doing really well and they're getting all the love and attention. Look, the market, people are most of the time incredibly short-term focused. So they're looking for
short-termism. You've said that before.
So my style is I try to take the short-termism of the stock market, flip it upside down to an advantage. So people are looking for good stories that sound good, that beat and raise. And as the market narrows, you get fewer and fewer of those, and they just get more and more popular because there's just not that many, and everything else is person non grata. Nobody cares. And I'm looking at the nobody cares, thinking at some point we're going to get, a real rating of the economy, but we'll need a portion of the economy at least to do better. You're looking for positive change at some point for that area.
Okay. So, again, back it up several months this year, you were leaning into some commodities. I think you were making a number of changes in a number of the funds with commodities because I wasn't always part of it. Tell us a bit about where that sits at this point.
It's a little bit less because, from March, April to the third week of May, copper was super strong.
Right.
So I still own copper names, and those trades are never going to be perfect because the volatility is obviously super hard to predict. But I do own less copper than I did earlier this year. The change I've made more recently is gold's been super strong, right? We've seen central banks buying and whatever's happening, and gold, US dollar being a little bit weak, and central banks cutting, and the cost of paper, which is the alternative to gold, getting a little bit cheaper. So gold's been super strong, and I don't want to chase that. There's a few good businesses in there, but it's not the easiest business in the world. I visited gold mines; it's a tough business, and so I don't think clients would expect anything otherwise, but I've been fading the gold rally, And what's not been really good is, everything kind of consumer related, transport related, and that's where the money's going. The money's going towards the pain. Selling what you have in a portfolio that's done quite well, consumer staples, safety, earnings growth, and slowly moving into where the pain is.
Okay, do you still stick with, there have been pipelines that have been brought on this year that have, to many people, changed the story of basically getting our oil to Tidewater. Is that of interest to you? Was it of interest to you? Has it changed? We're still in the commodity story here.
Yeah, on that point, I still feel the same that what I've said in Beverly Hills earlier this year. I do feel on a relative basis that clean energy, it's been kind of in a tough spot for 10 years. Unfortunately, the world's shrinking again. Lots of bad actors. Where do you want to get your energy from? The world is energy hungry. There's renewables, there's all these things. We need nat gas for, base load. And now that we have a pipeline, I think it leads to tidal water, it leads a little bit more to the Keene Basin, being able to grow again. So if you think about Keene Ops, a little bit in Greater Canada, there's some exposure to, regrowing production in some of the basins. Some of the basins look quite good actually in Canada. And now that the spreads can come down a little bit because we have more access, more alternatives. So yeah, it's not a thematic for climate leadership, but for Keene Ops in Greater Canada, definitely that's some exposure I have for the fund. So on a relative basis, if you want energy exposure, Canada's not a bad place to be.
Right. You've got sort of this, as you said, the world's shrinking. There's a near-shoring trend that it's not new. We've been talking about this for years at this
There's
point.
There's nearshoring in everything.
Yeah,
that's
in everything.
Only true in energy. Yeah.
Okay. So let's go to sort of the financials, not so much the financials themselves. Well, you'll tell us whether you're invested in those or not, but kind of the mortgage story as it relates to the consumer. We've gone at the consumer from other directions. The big story is we have mortgage renewals all over the place coming up over the next couple of years, this year too, and what it ultimately means for the consumer's ability to spend. Just take us into that story and what you see that you either like or are absolutely staying away from.
Yeah, so unfortunately, it's not our finest moment as a Canadian economy. Like on a per capita basis, we've been in a recession for over a year. Our consumption per capita is shrinking, our GDP per capita is shrinking. It's tough, and the toughness has been accelerating. I was reading again a great piece of research yesterday on the train, and it's unfortunately gone from bad to worse. We haven't seen the second positive derivative yet in Canada. As the rate resets are coming, it's putting a lot of properties underwater versus cash flow potential. And that's going to bleed into lower multifamily starts. And it's difficult. I think I read a statistic, I think 80% of condo owners that are landlords in Toronto, they're cash flow negative. People are struggling to close on properties. So yeah, it's super tough. And that's why the relief is coming, but it's coming in slowly. So the central bank is independent. They're trying to fight the inflation beast and slay it, but it's hurting a lot of people. We have rate reset in Canada, right? So a bunch of people have rate reset, and we got some this year in 25 and 26. So relief is coming, but it's slow and it's tough. And
so, is there a contrarian kernel in there or not?
Well, not yet. That's the one thing that I've struggled on the Canadian side is I think we just have a fair bit of issues. Our real GDP per capita has been going the wrong way. Population growth is probably going to slow a little bit. Mm-hmm. We got issues. And as long as I want to be a contrarian investor, I just want to give it a little bit more time, see how we does settle. We'll be fine as a country over 5-10 years, but it's a little bit of a tough moment. So I haven't been quick to, jump 2 feet into Canadian cyclicals, for example.
Okay, let's go back to the transports just for a second. That was one area that, as you said, it was, there are a lot of different stories within that. There's sort of an inventory cycle that finished up, and then it was a bit dry for a while. There's obviously the consumer demand story in there. Do you like transports? Is that an area?
I do. It's a big part of the funds.
Yeah.
Dave, it's important to understand, the economy is, and especially post-COVID, every cycle is almost like off balance, right? The transports have been in a recession for 2 years. This quarter, the quarter we're going to enter, Q4, this is going to be the 24-month, recession in transports. And it started by inventory destocking at the retailers.
Right.
There was too much capacity in trucking post 21, 22. Easy to buy a truck, make a lot of money. We're 2 years post that. The inventory destocking has started at Walmart and Home Depot and others. So now the inventory is way healthier. And now we're left with the consumer, right? The pricing has been terrible. 2 years of negative pricing. In some industries, it's the worst pricing since 07, 08. Some industries are worst pricing since 1989.
Is that a trough? Do you call that a trough?
We're hopefully we're getting close to it. Like, there's industry veterans telling us it's the worst cycle in 30 years. I mean, it's a hell of a comment, right? When you think about what's happened the last 30 years. So this is what I'm attracted to. LTL, less than truckload, intermodal, maybe a little bit of regular trucking, some of the railroads. Like, it's been tough.
Right.
And, the money just hasn't been there. And, those are also early cyclicals. And buying the better business, what's really important to understand is I'm trying to buy the better businesses in that pain. Because you can buy like a regular trucker and you're probably going to do fine. But it's not necessarily a great business I want to own for 5 years.
Okay.
But there's some better industry dynamics like an LTL or intermodal that's like, well, there's some really good businesses with high return on capital there. And they're facing this really tough moment, but I think I can buy it and hold it for quite a long time.
Okay, I was going to ask you that about time. Like, just sort of time being your friend. It's one of the pieces of your style. I think you look for that, right? Is that
well,
fair?
I try to. I mean, so there's many aspects to that, but
there are.
Time, the luxury of time, I call it, might be the last great tool we have to outperform the market, because everybody's focused on this quarter, next quarter, this week. We consume daily news and,
the short-termism.
Yeah, the short-termism. Yeah. And for me, it's like, okay, well, can I outlast my competition on not only looking at stories differently, but also maybe holding names longer? Can I hold names for 10 years that are like fantastic stocks? So I've actually changed that way over the last 10 years as a portfolio manager. I used to be quick in and out, and now I try to be a little bit more like Charlie Munger and Warren Buffett. If you bought a great business at a great price, now it's a great business on an okay price. I might own less of it. It might be from 6% to 3%, but why would I sell it? Because almost all alternatives are going to be worse. So Charlie Munger, his second biggest holding after Berkshire was Costco. Costco is an incredible business, trades at a quite high multiple that is deserved. It's a unique culture, but if you bought it at a right price in the future, it's really hard to beat Costco.
Yeah.
So
there's
that's
just many blueberries when you buy them. It just feeds the family for a whole week. Yeah. Okay, take us back into just a little bit of a discussion in financials. I mean, are they of interest to you? Basically, is the question. For Canadian investors, do you like anything about it? Is financials, it's often not part of what you invest in. Is that still the same?
Yeah, so from the top down, I don't do the most financials because it's hard for them to grow 15, 20% a year. If you got a financial that's using their balance sheet to grow 20%, 30%, oftentimes it ends up in a blow up. So, I'm looking for 15, 20% growth of earnings over time. Financials are a little tougher to do that. That being said, I'm in Toronto because, we had a banking conference this week. And, this morning we're meeting right now, actually, and I'm going to join them later with all the bank CEOs today. Yeah.
They must have good food.
The food's all right.
Yeah.
I tell you, there's a lot of security. I've never seen so much security at a conference. Really? I don't know. It must be tough to be a bank CEO nowadays. But so we're meeting with them. We're gathering information. Greater Canada, I'm underway to all the big banks. It's been okay. It's been and I think it's illustrative a little bit what's happening in the market between the have and the have-nots. Yeah. We've got 3 banks doing really well. Mm-hmm. You got 3 banks not so hot. And the delta in them is very large.
So is something of interest to you there?
Yeah, I wish I would have owned a little bit more of, the 1 or 2 that are doing well. But yeah, I am interested. And that's the meeting we had this morning, the first meeting we had with one of the bank CEOs. But I think it's also illustrative of what's happening in the market is
For sure.
the difference between good news.
Mm.
The World Bank is good news, right? And I'm a small shareholder, but good news is getting bigger multiples.
Right.
And we're meeting with the CEO this afternoon, so maybe I will change my mind. And the bad news, punish. And I think that's a good example that I think everybody can understand, that illustrate what's happening in the market. Good news, really healthy multiples. Bad
Almost
news,
across the sectors, right?
Across the sectors.
Yeah.
And what I've been a little surprised is the bad news. It's like there's no price for it. Like it's just you won't touch it with a 10-foot pole. Like it's just crush the stocks. And I'm gonna focus there. I'm gonna try to find good businesses in there that I can hold and turn things around.
Across the boards, how has your strategy changed, if at all? It changed earlier in the year. We mentioned that, we kind of went into the commodities discussion. Any recent sort of change in strategy you want to talk about?
Not really, not recent. Everything we've talked about, cyclicals, early cyclicals, and look, it's been incredibly painful. We were chatting earlier. Like I think I have a definitely top 5, probably top 3 toughest 6 months I've had in my career. So I don't know if you say top or bottom, but it's been a tough 6-month stretch. So the pain is real, but what I'm trying to do is stick with the plan. Not lose my mind, work really hard, try to exercise, but really just try to stick with the plan that's worked in the past on going towards the good businesses that are not doing well.
Right, and
so
investors expect your style from you.
Well, hopefully, and that hasn't changed, right?
Yeah. Okay.
So right now that the pain's been real, I'm not looking to make like huge changes, right? Like stick with the strategy, check your thesis, make sure you're right, or you're going to be right eventually. But that's really what I'm doing.
Couple of questions. So we spoke about commodities. Any changes there? The question is, Hugo, will you be allocating more to commodities?
Recently, I've been allocating less. We talked about that. Copper had a nice rally. Oil and gas. I mean, the commodity's been down. The stock's less so. Gold, I've been allocating less. I've sold a fair bit of gold, actually. I would say that if copper keeps falling every day, like it did yesterday, at some point I'm going to start allocating more. But you're going to need a better economy for copper to work. So, but that's certainly a cyclical that I'm keeping in mind. Sold some in May, didn't sell it all. It's never perfect. Haven't been very slow to add. But if it keeps going, at some point I'm going to pick away at my 3, 4, or 5 best ideas, thinking that at some point I think we're going to have a pretty big deficit in copper. The mine supply is just not there. Yeah. It's so hard nowadays to build a new greenfield. It's so hard. So much capital, so many issues, so many negotiation with the government and local authorities and water management. And now you got to produce probably your own renewable electricity. It's like a world-class copper mine is probably like $10 billion nowadays. And where are you going to build it? Like country, they don't magically appear in Ontario, right? Most of the time. So do you feel comfortable where they are? So I think we're just going to see a little bit of greenfield and more brownfield and incremental supply unlock. So if demand grows, it's going to be tough. We didn't invest a lot the last 10 years in mining, and it's unpopular, but we need it. So I want to keep that's kind of the long-term thesis. Yeah. The short-term is China stuff and the economy stuff. So if the demand story is a little weak because the supply issues are there. So if we start facing these bigger deficits, and if the stock prices go back to attractive price to books, I'm going to lean in.
Okay, back to interest rates, your favorite story. So this question is, what is your view on the Canadian dollar in light of the rate cut? I mean, that question of does it hit the bottom, the Canadian dollar? Maybe that's useful. I don't know. But your thoughts?
Yeah, I'm not allowed to make predictions, but I think a lot of us at Fidelity have run our funds overweight U.S. dollar when possible, right? If you think about Greater Canada,
right?
And I think that's been a little bit the gift that's kept on giving, because I think we're a little bit on different glide paths, unfortunately. We get hit in the face way faster with higher rates, right? Everybody rates reset here every 5 years, right? So we've been hit by it. It's tougher. We got housing issues. We got so many problems I think the glide path's just a little bit faster here, unfortunately, and down. Well, unfortunately and fortunately, but from a Canadian dollar perspective, it should lead to, just generally a lower dollar. So I don't expect a lot of change there.
Let's finish out with the consumer. Just some more thoughts on that. It's kind of one of the main pieces of what we've been discussing, and it's related to everything to do with interest rates and what we've been talking about. Travel stock, does that interest you?
I bought one for the first time in a long time last week, actually.
That's a consumer. Oh, okay. Well, be careful then. But in any case, I was going to ask you broadly about travel. I didn't know that.
Well, travel. We had look. A lot of companies are following the same cycle. They had a huge COVID boom, and obviously travel happened a little bit after.
European cities crawling with tourists.
Yeah, yes. Exactly. In Barcelona, residents like spraying water guns at tourists, right? And now we're starting to come down on the other side of that. Yeah. So I think in travel there are some superior business models, right? Normally they're not airlines, and there's other ways to do this. And if you got a great business that they've cut earnings this summer because expectation got a little high, but you got a 10-year runway on their business model and high return on invested capital and really high-performing organizations. So these are the names I'm gonna focus on. Yeah, definitely. It was a great summer. It seemed, I don't sound too privileged, but it seemed like everybody traveled in 2023, and now the purse strings are a little bit tougher, and people are, they've adjusted their travel. A lot of the people I know, and I didn't, same this year, we stayed closer to home in 24, and that's going to last a while. And so we'll see. But, the budgets are shrinking for a lot of consumers, right? And that discretionary portion is absolutely getting slashed. So as it's getting slashed and companies are reporting things are tough, I'm going to look at those. Okay. Final thoughts for investors that you want to leave today. Maybe themes across your funds, or even if you want to zero in on one in particular. But what would you like to leave people with today that you're, looking at, say, 6 months out? Time is your friend. Well, people have been very kind to me because, like I said, it's been an incredibly difficult 6 months, and that's, my cross to bear. I'm trying to stay sane, and I can promise that you look fine to me. Well, it's the golden retriever, she loves me every night when I come home, so that's good. But it's the same process, right? And I've lived through these moments before where it seems like every decision you're making is a bad one. But you want to kind of stick with the plan because of the long-term success that it's demonstrated. And that's what I'm doing, right? So I'll make small incremental changes to try to get better. Like I've tried a few new things, and I'm going to travel to a few more conferences this fall. So it's going to be really busy. The fall is always super busy, right? I'm here for a conference. We're going to meet a lot of our clients in Montreal, in Toronto, in Ottawa, in Arizona. We're going to meet with our clients. But it's just it's the effort. I was talking to my CIO, my boss, earlier this morning. I'm really happy with my effort year to date. Like I've been working really hard. I've met a ton of companies. It's just the outcome just hasn't been obviously what I wanted it to be. So we're going to keep putting in the effort, and hopefully at some point the outcome will be different. Okay, well, we'll speak to you in a few months, and I'm sure there'll be some very interesting things to catch up on. Hugo Lavallée, great to see you in person. Nice to know you exist, and have a great time at all the conferences. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.